For his views on what the president's decisions meant for the Fed and for monetary policy, welcome now Dr. Paul Krugman. He's Distinguished Professor of Economics at the City University of New York and recipient of the Nobel Prize in Economic Sciences. So, Dr. Krugman, thank you so much for being with us. I guess my question is, what does this mean for Fed policy? And by the way, what should that policy be no matter who's at the Fed?
Okay, so it's really hard to find any error between Powell and Brainard on monetary policy right now. We have a extraordinarily dovish, open-minded, flexible-minded Fed these days, one that is really concerned not to tighten prematurely, is willing to give the transitory inflation hypothesis plenty of running room before it really wants to slam on the brakes. And that's true of both people. And I have never been able to get myself worked up about this decision one way or another. I mean, I think they're both really good. Lael is an old student of mine, but that's a reason to actually be even more cautious. And no, it's in terms of monetary policy, we still have the Fed on wait and see. And I don't think it really made a difference on that, which one became chair. And of course, giving Brainard a powerful role in monetary policy even further reduces the difference that this decision might make.
So, Paul, Jay Powell's already said we're tapering. We've begun the tapering process. Now it seems like the debate is, should we speed it up some from what they were talking about, mainly tapering so that we're basically not buying a lot of new bonds by the middle of next year? What do you think about that in terms of inflation? Because that's what's driving it. A concern in inflation is larger than what the Fed had anticipated.
Sure. Inflation is well above Fed anticipations. The Fed was expecting 2.4% for the year as late as March. So that's we're clearly running way above what the Fed expected. It's hard to think that the large-scale asset purchases, LSAPs, quantitative easing, is really important in any substantive way. I mean, there's actually never been really solid evidence that it mattered a lot for anything, except as a kind of indicator of future Fed rate hikes. It's just now, and there's a pretty good. I am in fact in favor of rapidly tapering on the LSAPs because what those purchases do, I think they really do almost nothing. And what they do is they create some constraints on the Fed's ability to act. I mean, the Fed, if inflation ends up being less, fading less rapidly or not fading at all than I expect, and I think the Fed expects, the Fed needs to be able to respond. And it would be it's kind of embarrassing, not impossible, kind of embarrassing to be raising the Fed funds rate at the same time that you're still buying lots of long-term assets. So in a way, the tapering should be more sort of clearing the decks for a flexible policy rather than anything else.
Well, I mean, Larry Summers well. We have him on regularly, and he says he was a classmate of yours, you're a friend of his, but he has a different view on this. I guess to summarize briefly what Larry's saying is basically, if you're not going to fire until you see the whites of inflation's eyes, we're seeing the whites of their eyes, that it's here now. And why don't we taper much more quickly so we can get to the rate increases that you suggest?
Well, I would taper. I mean, I would taper quickly. I think that's worth doing, but I would not raise rates yet, because the fact of the matter is, I mean, let's talk about how this debate unfolded. Back early this year, Larry and other people, Olivier Blanchard, former chief economist of the IMF, looked at the American Rescue Plan and said, this thing is enormous, and if it has anything like a standard multiplier, it will lead to a drastically overheated economy. People like me said, I don't think the multiplier is going to be very large on this, and I don't think it's going to be all that inflationary. And what's actually happened is that the multiplier has not been very large. If you look at domestic demand, it has not grown at an extraordinary rate. It's grown actually no faster than normal growth in the economy's productive capacity, if anything, a bit more slowly than that. So the low multiplier happened, but on the other hand, inflation really did take off. And so then the question is, well, how do we're having inflation, but it's not inflation according to the script that people like Larry were promulgating early this year. So yeah, they were more right about inflation than people like me were, but they seem to have been right for the wrong reasons, which is, that's an academic discussion. The question is, what do you do now? But it does bear on what you do now. A lot of what we're seeing seems to be bottlenecks, seems to be not so much that we have excessive overall demand as that we've had skewed demand. We've had people still buying a lot of goods and relatively few services, and we run into all of these supply chain issues, which are clearly, those won't go on forever. In time, you can already see there's already some evidence that supply chain issues are letting up. And over time, the economy will adapt. And also, this skew in demand is gradually reducing as the people sort of come out of pandemic mode and start to buy more, start to go out to restaurants, start to go to the gym instead of buying Pelotons. There's still a question of, are we, even though the economy hasn't grown all that much, are we overheated all the same because of the Great Resignation? Because lots of workers are not coming back to their jobs. And that's what's still kind of up in the air. We don't know that. But the one thing you can say right now is that we do not have any evidence of, stagflation, wage price spiral. Wages are going up because demand for workers is high and supply is low. The prices of goods are going up because of supply chain issues. There's no indication whatsoever that anybody is raising prices because they expect everybody else to raise prices, which is how you get into stagflation. We're not in that phase yet. And as long as the Fed is keeping an eye out for that, I don't think we need to be too worried.
Well, as you say, not in it yet, but thus far, at least as I've seen the numbers, wages have gone up, but not as fast as prices. Are they going to catch up? And if they do catch up, could you put you into that wage price spiral?
Well, sure. I mean, but the point is really it's not something you can settle actually by looking at just at the wage numbers, the price numbers. You really need to talk to people. This is one of these things where, we have various measures of inflation expectations, which are all basically junk for this purpose. The bond market is not a junk measure, but unfortunately, the bond market doesn't set prices of goods and services. The consumer inflation expectations we know that consumer inflation expectations are basically the price of gasoline. It's not telling you very much about what people really expect. And so you really need to talk to businesses, talk to workers about what they're doing. And so I, at least, am closely following surveys like the Beige Book for evidence that anybody is starting to get into a persistent inflation mode of thinking. And so far, there's not a hint of that. It's just not out there at all in the studies. So, you need to be alert. But on the other hand, raising rates, remember the fiscal stimulus, the big fiscal stimulus is behind us now.
Right.
And, effectively, we're going to be seeing fiscal tightening from here on in, even with, Build Back Better will make very little difference to that. And the risk, there's a very serious risk that the Fed might raise rates because it's worried about inflation, then discover that the bottom is dropping out on aggregate demand. So it's certainly not a slam dunk thing, but, Larry thinks it is, but
right.
He's wrong.
But Paul, to come back to the Fed for a moment and monetary policy, because as you say, fiscal policy, there's going to be some tightening just as the numbers come off. But on monetary policy, we have two mandates for the Fed. It's both price stability and also full employment. Do we know what happens if those two things are pointing in opposite directions? Because some people would say right now, what we're doing is we are losing some of this price stability through inflation, and we cannot eke out that last part, whether it is women that are not coming back to the workforce, whether it's people of color, that you can run it as high as you want and really risk things, and you're not really getting the payoff when it comes to full employment.
Oh, sure. There's no, we haven't, the lessons of the 70s are not irrelevant here. There are limits. You cannot do an Arthur Burns, Richard Nixon, and just reflate the economy without consequences. On the other hand, that's a long time ago, and we've seen very much that there are other risks out there. So I'm still very much a believer that once the pandemic is behind us, once all of this dislocation is behind us, we're going to be back in an environment where we are persistently facing weak investment demand. The demography, if nothing else, will do that. It's secular stagnation, which is a doctrine that was been preached a lot by a guy named Larry Summers. And in a secular stagnation world, the one thing you really don't want to do is re-enter the world of secular stagnation with low demand, inflation that is too low. I mean, there's actually a pretty good case that says the 2% target is too low, but even you certainly don't want to come back into sort of normal economic times with inflation expectations having fallen to 1% or 0.5%. And there's a big risk if the Fed tightens too soon that it will end up having thrown away its ability to stabilize the economy once all of these pandemic-related shocks are behind us. Now, it obviously could go the other way, but I think they're really asymmetric. If inflation is running hot, persistently, we know what to do. It's not pleasant, but we know what to do. You raise rates. If inflation is running too low and the economy is stagnating, then you actually don't have a lot of policy tools. I mean, you can use fiscal policy, except we're very likely to have governmental gridlock and when that comes around, and the Fed can only do so much.